Development Limited Q3FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Dattaprasad Tambe, General Manager, Finance and Accounts. Thank you, and over to you, Mr. Tambe.
Thanks, Neerav. Thank you all for joining us on the Westlife Development Limited earnings conference call for the quarter ended December 31st, 2021. We are joined here today by Mr. Amit Jatia, Vice Chairman, Ms. Smita Jatia, Director, and myself, Mr. Dattaprasad Tambe, General Manager, Finance and Accounts for Westlife Development Limited. Please note that our financial results and investor presentation has been mailed across, and these are available on our website as well. I hope you had the opportunity to browse through the highlights of the performance. We shall commence today's call with key thoughts from Amit, who will provide a strategic overview. We shall be followed by Smita to take you through the key business initiatives with overall operational progress and the strategic imperatives that lie ahead. I will cover the analysis of the financial performance. At the end of the management discussion, we will have a Q&A session. Before we start, I would like to remind you that some of the statements made or discussed on this call today may be forward-looking in nature and must be viewed in conjunction with the risks and uncertainties we face. A detailed statement and an explanation of these risks is available in this quarter's press release, investor presentation, and in our annual reports, which is available on our website. The company does not undertake to update these forward-looking statements publicly. With that said, I would now like to turn over the call to Amit to share his views. Thank you, and over to you, Amit.
Thank you. Good evening, everyone. Firstly, I wish all of you a very happy and healthy 2022 and hope you and your loved ones are safe. 2021 was a special year for us for many reasons. To begin with, it marked a significant milestone for us at Westlife as we completed 25 years of operations in India. Looking back at the journey we have traversed, there is so much to be proud of. From a single store in Bandra to over 310 stores in 44 cities, from pioneering large-scale lettuce farming to setting up various ecosystems from scratch that have taken lives of their own, from a 10-employee store to building a 10,000-strong family, from bringing a quintessential American brand to India to making it a household name. Our journey has been defined by leadership across menu, people, supply chain, and technology. Our growth has been consistent, sustainable, and a true testimony to our commitment to the market. We have also been very mindful about our impact on the environment and the community we have been part of. We have therefore woven sustainability in our business right from the start and are very proud of our ESG efforts that have resulted in positive impact in terms of reducing carbon footprint, skilling the youth, and generating employment. There have been many wins for us in these 25 years, but the one thing that we are most grateful for is all the love we have received from our customers, 300 million strong customers. And we thought the best way to celebrate this milestone would be to do something to give back to the community. To mark our in India, we have announced 25 acts of happy, 25 big and small initiatives we hope will bring a smile to the faces of our customers and employees. Smita will be telling you more about these initiatives. But like I said, the year 2021 brought in many more reasons for us to celebrate. 2021 was the year we saw our strategies come to life. We believe that the last 20 months have been an inflection point for our business. What started off as an unprecedented crisis steadily turned into a springboard for our next phase of growth. Our concerted effort to build.
Sorry to interrupt you, we are unable to hear you. Hello.
Yeah.
Mr. Jatia,
our concerted efforts to build an all-day part menu an omni-channel brand, and a strong value proposition made us the customer's favorite. Our technology investments to pivot McDonald's from a food to food tech brand started manifesting in the way our customers used our brand across several touch points, helping us own the convenience proposition. This complemented with our sharp focus on cost and operational efficiencies, a unique real estate portfolio, and best-in-class supply chain helped us accelerate business and set new benchmarks. We saw this play out strongly in Q3FY22, as we delivered our best ever quarter so far, firing on all cylinders, notwithstanding the restrictions and volatilities. The convenience channels that we built over the last 20 months continue to grow stupendously. As we have hypothesized right at the beginning of the pandemic, the convenience channel continued to add incremental revenues, led by new brand use cases, even as dining came back strongly. This is a true testimony to our omni-channel strategy, where customers being able to access us wherever and however. Menu innovation is our core strength, and this quarter we added the new Gourmet Burger Collection to our menu. The customer feedback for these new indulgent range of burgers have been phenomenal. Last quarter, I shared how our new fried chicken platform was aiding the average unit volume growth in a big way. Now with these new burgers, our AUV is set to accelerate further, boosting the overall profitability of our restaurants. I now hand over to Smita to take you through the earnings presentation.
Thank you, Amit, and good evening, everyone. Happy New Year to you all, and hope you are all keeping safe. I am happy to share that Q3 FY22 was our best ever quarter with robust trends across all business parameters. As a stronger new normal set in for us, our revenues jumped by 46.7% Y-on-Y to 4,768 million, our highest ever in 25 years. Our SSG for the quarter stood at 44% Y-on-Y. This was driven by growth across both dine-in and convenience channels that grew by a solid 39% and 55% respectively. Our performance continued to accelerate through the quarter. We started by clocking an all-time revenue in October and then beat that in December, setting a new benchmark. This growth in revenue was complemented with continued cost efficiencies. So despite all inflationary pressures, we clocked a robust gross margin of 66.4%, an improvement of 48.3% Y-on-Y. Our strong top line ensured a robust 60.3% Y-on-Y jump in restaurant operating margins that stood at 22.6%, again setting a new benchmark. We also reported an all-time high EBITDA of INR 836.2 million, a 61% increment Y-on-Y, taking our EBITDA margin to a new high again. As a result, our PAT zoomed to an all-time high of 208.2 million, a formidable jump over the same quarter last year. What is particularly interesting to note is that this growth came in a quarter that continued to see COVID-led restrictions. But our strategy pegged on a strong channel mix enabled us to activate different levers depending on what the external environment was. This helped us capitalize on the tailwinds for the organized eating out sector and grow our overall revenue pie, which we believe is the new baseline for us. Q3 FY2022 was a true manifestation of all our efforts in the last 20 months. Our vision to build a one for all for one brand with an omni-channel presence and relevant menu offerings for all day parts and segments truly came alive in this quarter. We saw a strong dine-in as malls and food courts recovered. This, however, did not result in any cannibalization for our convenience business, which continued to accelerate. Like you can see on slide number 11, our sales mix over the last few quarters has had a significant share on convenience-led revenue. Even in this quarter, where most dine-in restrictions were eased, 45% of our revenue came from our convenience channels. This is a testimony to our definite pivot to being a convenience-led brand with a stabilizing channel mix. As you know, we have been making
Vijay, we're unable to hear you. Ma'am, can you hear us?
Hi, can you hear me?
Yes, ma'am, now we can hear you.
Okay. As you know, we have been making concerted efforts to build and grow our meal day part through our and premium burger platform. I am happy to share that this quarter we saw a robust 50% jump in our meal day part revenue. This led to a larger revenue pie on the back of new customers, new brand use cases, and growing AUV. Menu innovation, omni-channel strategy, and network expansion continue to be the key levers of our strategy. Our aids our all-day part proposition and enables us to own both the snacking as well as the meal proposition. Reinforcing our burger leadership this quarter, we launched our new Gourmet Collection, a range of premium made with exotic ingredients and sauces. This helped us bring in new customers to the McDonald's fold and further strengthen our meal proposition. As a result, our burger meal volumes grew by over 50% as compared by June 2021, and we saw a good jump in our brand scores for great tasting burgers. As you know, chicken is emerging as a pivotal platform for us, giving us a strong foothold in the South market and helping us boost AUV in a big way. This quarter, we gave our chicken offering yet another fillip by launching the Rashmika meal. As a part of the campaign, we not just tapped into superstars' popularity to build brand relevance, but also led some disruptive innovations to build long-term brand recall. As a result, our chicken scores jumped up by close to 4 times. We also kept our final coffee platform buzzing with exciting new launches and marketing campaigns. Finally, as one of our 25 acts of Happy, we gave our iconic Happy Meal a wholesome makeover by adding a mixed fruit beverage and a cup of hot fresh corn to it. All these menu interventions together helped us increase our average unit per restaurant by a solid 30%, taking it close to 6 crores, which is 2 to 3 times of the industry average. I would like to highlight that this has come purely on the back of menu relevance without any significant capex investments, thus giving a boost to our second lever of our strategy. Our omni-channel strategy helped us complement our strong menu relevance by making the brand ubiquitous, accessible, however, wherever and whenever they like. We deployed a series of ATL and BTL initiatives to showcase these channels, including delivery, takeout, on-the-go, drive-through, and of course dine-in. This created new brand use cases, helping us acquire new customers and increase frequency of the existing ones. Convenience continued to fire with McDelivery yet again clocking an all-time high revenue. At the same time, we saw a complete recovery of dine-in in the quarter as malls and multiplexes came back. While McDelivery app continued to enable our convenience proposition, our McDonald's app, a unique offer engine that gives customers personalized offers, played a key role in driving in-store volumes and frequency. The app saw cumulative downloads of 1.3 million in the quarter. We also saw both active user base and average check for the McDonald's app increase significantly. With a stronger baseline, we are back on track with our expansion plans. This quarter, we added 8 new stores, taking our restaurant count to 316 restaurants across 44 cities. Close to 80% of our restaurants have McCafe now, while 100 of them are Experience of the Future stores. We are now ready to accelerate our network, doubling our new store run rate from 25 to 30 a year to 40 to 50 stores a year. With an investment close to 800 to 1,000 crores in the next 3 to 5 years, we are looking at taking our store count to more than 500. Our expansion strategy will be completely aligned with our omni-channel strategy. We will have a robust portfolio of Experience of the Future stores and stores with separate takeaway windows, enabling our customers to use our brand wherever, whenever, however they like. Inclusion and sustainability have been important pillars of our last 25 years. We have been very mindful about creating a positive impact on the environment and community. Last year, we launched Eat Equal packs that make the act of eating burgers easy for our people with limited upper limb mobility. This quarter, as one of our 25 acts of happy, we reinforced our commitment to inclusion through a refresh to the Eat Equal campaign. Eat Equal is an inclusive platform that we will continue to build. This unique packaging marks just the first step in the direction. We aim to launch a host of new, meaningful innovations to make the McDonald's experience easy for everyone. I now hand it over to Datta Prasad, who will take you through the financial highlights of the quarter.
Thank you, Smita. Good afternoon, everyone. Hope you all are doing well. I wish you a happy 2022. It's been a happy start for the year for us. As Smita said, we clocked all-time high sales of rupees 4768.3 million, a 46.7% jump from the same quarter last year. The same-store sales growth has jumped to 44%. The top-line results represent a continuation of our broad-based business momentum that is coming from both on-premise and off-premise consumption. We have seen robust business growth across all our channels: in-store, delivery, takeaway, and drive-thrus, thus reinforcing our faith in our omni-channel strategy. Let me give you some key highlights of Q3. We saw record sales in each of the 3 months, October, November, and December, resulting in highest ever revenue with high AUV of 6 crores. Our gross margin jumped by 48.2% despite inflationary pressures. This is because we continue to maximize our supply chain efficiencies and rationalize the food cost. The strong revenue growth led to commensurate increment in both EBITDA and operating EBITDA that jumped by more than 60%. This is on the back of operating efficiencies in utilities and M&R. The flow-through of the top-line growth also gave our margins a strong boost, and we clocked an all-time high PAT margin, operating EBITDA margins, and restaurant operating margins. As a result, our PAT increased manifold and created a new benchmark of INR 208.2 million for the quarter. We have complemented our revenue growth with continued cost leadership. We continue to target meaningful margin progress and are tracking towards our long-term margin objectives, demonstrating our ability to accelerate value creation regardless of the environment. We continue to maintain a strong balance sheet and a robust liquidity position by optimizing our treasury and working capital. Our relentless focus on internal improvement and driving synergies across our portfolio will enable us to extend our continued best-in-class record. Going forward, we are confident that our operating performance will continue to fuel growth in our already strong free cash flow profile. As a result, we are committed to our historical capital allocation priorities to invest in new restaurants, in existing restaurants, and opportunity to grow the business. I now hand it over to Amit for his closing remarks.
Thank you, Datta. The short-term volatilities are here to stay, but we believe we have the right playbook to navigate these and stay relevant to our consumers. We are bullish on the future and press the gas pedal. We have a solid strategy pegged on menu innovation, digital and strategic store expansion. With gourmet burgers, the chicken platform and McCafe, we believe we have the right menu strategy to retain, regain and acquire customers, increasing the baseline. We also have a pipeline of digital initiatives to drive personalization and enhance customer experience. Lastly, we've already started work on our expansion plans that we had announced in October 2021 as a part of our 25th anniversary. We have identified the opportunities to strengthen our presence and optimize our network. We have an aggressive expansion plan to increase our restaurant count to over 500 in the next 3 to 5 years, and already have a pipeline of close to 100 new restaurants that will fructify in the next 1 to 2 years. As we enter our 25th year, we are excited about the opportunities and the possibilities of our next phase of growth has for us. Very much, and I'm all for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi Amit. Hi Smita. Thanks for this opportunity and congratulations on the sales performance. I wanted to just understand first from a near-term lens. Have we seen any material impact from the third wave on operations and more importantly on the dine-in recovery and this ADS trend that we are witnessing this quarter? If you could kind of help us understand that part, that'd be helpful.
Yes, Smita.
Yeah. So mentioned that whether it's third wave or whatever the circumstances are externally, I think we've been true to an omni-channel presence, and we are able to kind of accelerate different channel mix depending upon what the external environment is. So obviously the third wave did see restrictions on dine-in again, but the good news was we were able to accelerate what we could on our other channels, and that's why even in December, while the last 15 days had restrictions, we were yet able to deliver a stellar quarter.
Perfect. That's extremely clear. Continuing on that, we have now seen 2 quarters of almost close to double-digit EBITDA growth, whether you take in adjusted or ICAP numbers or not. With the demand strength sustaining, would it be fair now to expect FY23 to see double-digit EBITDA margins, or if you would kind of help us give a sense on what should we look for as we go into next year, given that demand side looks fairly coming back to normal?
Thank you, Avi. I mean, as you've seen, I think we continuously pivot our business based on the situation. And, if you look at a 4-year trend, we've grown our EBITDA by 130 basis points every single year, if you leave out the COVID exception. And I had talked about Vision 2023 effectively, FY23, which is now sort of coming to close. And we had talked about a 13% EBITDA pre-Ind AS. I think we are at that number, and we definitely see that and more in the future. We will have an investor day where we will talk about our next vision, and as we boldly laid that out in 2016, we'll again boldly lay out our next 3 to 5 year vision in the next one. But yes, you can expect this EBITDA to remain as the baseline.
Awesome. And last, just a bookkeeping. Could you share what capex number should we expect for FY23, given that along with the 40-50 stores, there would be investments required in digital as well as supporting infrastructure. So that's all from my side. Thank you.
Sure. So firstly, I think you might have noticed that we've consistently reinvested back in our existing restaurants, which is why, whenever we open McCafe, we modernize the restaurant as well. So the important thing that, the industry, even in the industry, I think everybody will realize this over time, keeping a modern fleet is extremely important. And today the relevance of our designs with our consumers is at the highest. So we have 100 experience of the future restaurants and so on. So all those investments are going to continue. Essentially you can expect about 200 crores of capex for the next year.
Thanks a lot, Amit, and wish you luck for the future. Thanks a lot again.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir, and congratulations on a good set of numbers. So my first question is with regards to, in your presentation, I had seen one thing that, earlier there was a lot of focus on the value for money meals packages. But this time it was very heartening to see that, the gourmet burgers or the chicken offerings have also taken place. So can you just highlight how big the contribution from these two pieces, and are there their contribution increases led to the gross margin expansion also?
So it was not very clear, but whatever I could understand, I'll tell you. Firstly, in my opinion, it's not about, I think it's the evolution of a brand. And in our journey, the first idea was to introduce burgers to consumers and make it relevant. And that was the first phase of value, recruiting more users into the informal eating out category. What happens is once it becomes baseline, then you got to launch indulgence, which is what we have done now. But it does not mean that value is over. But yet at the same time, now consumers do expect indulgent products. So you will see a balance across these parameters coming from us. Like particularly gourmet burgers have just been launched. So obviously there's a lot of runway left on the gourmet burgers. I think fried chicken is also just the beginning. It is just our first step towards leadership in the chicken area. So essentially we are going to deal with that. Part of the question on gross margin impact, as you have seen, I always like to talk with facts. And if you look at 5 years of our history, 5 years is a very, very, very good basis for anybody to make a judgment as to where the company is headed. And through thick and thin, we have our secret recipe of how we are able to manage gross margins. And components of that past, it's around product mix, it's about managing supply chain, backward linkages to the farms, long-term relationships, and so on and so forth. So, I hope that answers the question, although it was not completely clear.
Sure, that definitely does. I mean, that was my point that, given the product mix, I would have improved this because of these new products. That also would have benefited the margins along with the cost efficiencies. But yeah, you have answered that. So the next question, is with regards to the recovery in the dining fee. So, I mean, is the dining recovery back to the pre-COVID levels? I mean, we understand that, many places there are still restrictions on the seating capacity to 50% odd. So if you can put some more light on how the dining recovery is and how it's panning out in the future as well.
Yeah, so just before the wave 3 kind of hit, pretty much our dine-in was close to around pre-COVID levels, around 90 to 95%, and that's what you have seen, that in the quarter, even dine-in has grown by 49%. So pretty much, again, I will repeat that depending on external circumstances, we basically just see which lever channels are we able to accelerate, and that is why we are very true to our omni-channel strategy, and we have a very robust platform that irrespective of what happens in the future, we are to be able to get what we can from our customers.
Sure. And just one last question from my end. The slide number 11 that we put the mix of, the delivery and the convenience mix, I would say, has remained very consistent around 40-45% or so. Should we consider this as a base case now going ahead with, dining now also getting recovered fully?
Yeah, I think that is the new baseline. There is an evolution, and as we said, new use cases which the customers have come with, whether it is using the on-the-go feature or whether it is ordering in delivery even on a weekend. Of it, we feel that this is going to continue as a baseline where both dine-in and convenience channels will have a very respectable contribution.
Okay. Thank you, ma'am. That's all from me.
Thank you.
Participants, you may press star and 1 to ask a question. The next question is from the line of Percy Panthaki from India Infoline. Please go ahead.
Hi, team. My first question is on the margins. You mentioned that you would do a 13% kind of pre-Ind AS margins very soon. Just want to understand the implications of the royalty increase which could happen 2-3 years down the line. I think it is slated to increase by approximately 300 basis points. So once that increase does take place, what kind of margins are we targeting on a pre-Ind AS basis?
Yeah, I have maintained this before and I've answered this many times that firstly it's in 2026. Okay, and we have always maintained whatever vision we set up is the absolute number that we are going to deliver. We are not going to lose the margin because royalty increase is there. Also, I have mentioned this in the past that while currently the path of royalty is up to 2026, there is, it's unlikely that it will go from 5 to 8%. So that path we will try and resolve and bring clarity over the next couple of years. But we are not very worried. If we are able to deliver whatever we are talking about, both in terms of unit growth as well as the average unit volume, in any case, globally, we are able to absorb these royalties. So that's what it is. But Smita would like to add something.
I mean, the only thing I would add is here by FY26, as you saw in this quarter, we are going to get, as what we had always said, operating leverage benefit. You already saw the operating leverage benefit come with a 6 crore AUV. And by 26, the 6 crore AUV will also grow and giving us the operating leverage to cover up for whatever loss of royalty which could come up later.
Understood. And this 8% number, is that a standard number for McDonald's across other franchisees globally?
Absolutely, because I don't think I'm a bad negotiator.
Right, sir. Secondly, just wanted to understand in terms of the normalization of dine-in. Although, Q3 was a very good quarter, but I'm sure there's still some more leeway for normalization. Or do you think that basically there is some amount of channel mix change which has happened, which is permanent in nature, and therefore comparing the normalization percentage to a pre-COVID level is not necessarily right, because that benchmark itself has changed as people have changed their habits, etc. So any thoughts on that?
Yeah, I have shared this over many earnings calls. I'll explain what I mean. Firstly, let's take the convenience channel sales today at 100 rupees. Okay, so I strongly believe, and let's say earlier the dine-in was 80 rupees, right? So what I'm saying is that the 80 rupees is going to come back to 80 for sure, and it's going to further grow, but the 100 is not going to drop. And therefore, in my opinion, percentages are irrelevant. Essentially, our sales will go up by 8 to 10% with the new channel mix. So, I had explained that earlier as well. I hope you are able to see it, because it's finally rupee value that matters, right?
Right. Understood. And lastly, just wanted to understand in terms of now that you're accelerating your store addition, 2 sub-questions to that. One is that the new stores, are they going to be of a different square footage versus your existing stores? And the second sub-question to that is that with the new stores coming up, do you think that sort of to some extent depresses the sales per store on a total average basis because the new stores open up at a lower level? And how do we look at same store sales growth, which is a slightly different metric versus just sales per average store? How do you look at same store sales growth going ahead once this COVID base issues, etc., are normalized?
Okay, so I have mentioned this in pretty much all our earning calls. We do not believe that we are going to reduce the size of our restaurants. We will continue to build the 2,700 to 3,000 square foot restaurants. So far, it's worked beautifully for us, even with all the new restaurants. I think that kind of answers your second question because, I don't see my average unit volume dropping. That's not been factored into our plan, and by no standards are we sort of going in that direction. Lastly, on stabilization, as I have said this many times, 8 to 10% same-store sales growth is kind of what we shoot for. So that's pretty much on stabilized basis is what we will gun for.
Okay, sir. That's all from me. Thanks and all the best.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Vicky Punjabi from JM Financial. Please go ahead.
Hello. Thanks for taking my question, sir. So just again on this delivery and dine-in kind of split. Now, with McDonald's, the thought is that given the cafes which are better suited for a dine-in segment, the relaxation of restrictions that we saw in the last quarter, which was almost a normalized quarter pre the COVID hit. The thought process for me was that you would see a sharper growth in the dining segment, but when I look at the growth rates, I think delivery is still continued to outpace the dining segment in terms of growth. Could you help me understand what's the thing here, or were there certain factors that actually kind of impacted the dining segment in this quarter as well?
Firstly, I kind of disagree with the hypothesis that McDonald's is a dine-in brand. I've mentioned this many times, that we operate in a segment called QSR, and table stakes of QSR is around convenience, right? And convenience is all about just taking things away. And I mentioned this before that globally, even pre-pandemic, 70% of our business was off-premise. So you've got to understand that is the segment we operate in. In India, the brand had been building, and therefore it is what it is. And what has happened is through COVID, the pivot has been sharp, and the last quarter is a phenomenal example of how this omni-channel thing for McDonald's is a reality. So to my mind, in-store restrictions, by the way, even in the last quarter, pretty much half of October and the last 10 days of December, which are the most important days, we had tremendous restrictions in dining. But yet we were able to deliver an almost 500 crore quarter, which we've never done before. So imagine if the restrictions are not there, our own expectation was higher than whatever numbers you see. And we got impacted because of the things I just talked about. So my belief is why do we keep talking about average unit volume along with new store openings? Because it goes hand in hand. The first point is that if some other brand wants to open 80, we believe that our 40 restaurants are worth 80 because of the average unit volume we do. And we are not saying that by opening the 40, the 6 crore should go down. We are in fact shooting. Our vision talks about a much higher average unit volume over time, and that is also visible in the global McDonald's model, which is over a 70-year horizon. If you look at McDonald's global average unit volume and you look at any of their competitors, is almost double across the world. So I don't know if that answers your question, but by and large, that's what it is. I think Akshay, that's really what we feel.
Sure. Thanks a lot for that. Just on, conceptually, if the mix changes in favor of delivery and the revenue per store would have remained the same, just in a hypothetical example, would that have a negative implication on the EBITDA margin per se?
No, because we've been through it over the last 5-6 quarters, and you look at our growth margins. Other than very heavily impacted quarters like the first quarter of this year, where everything was shut, right? It was the beginning of second wave. You cannot compare that because everything goes topsy-turvy. But outside of which, even with delivery being 70% of sales, our margin profile has been pretty solid.
Sure, sir. So just while we are here, I just wanted to understand. Previously we were talking about say SSGs relative to pre-COVID levels, or say a December 19 quarter. If I have to look at the overall unit SSG versus, say, instead of the base Q3FY21, we look at versus Q3FY20. What was that? I mean, what that figure could be?
I didn't understand the question actually.
I just wanted to know, the SSG versus say 3QFY20 levels, rather than 3QFY21 levels.
Versus 20.
Yes. Just pre-pandemic.
It's about 10%.
Okay. And sir, just last.
We believe in sharing SSG, pretty transparently.
Yes, definitely, sir. Last thing, in this quarter I couldn't find the disclosure regarding the pre-Ind AS EBITDA margin. I don't know whether I have listed or not. Could you help us understand what was the pre-Ind AS EBITDA margin for the quarter?
Yeah, they are all better than whatever numbers you saw. I should have been there as an annexure. We will email that to you, but I'll tell you the numbers. I mean, I know the absolute numbers. It's 13.5% EBITDA pre-Ind AS, and our profit, of course, in an absolute number goes to 27-28 crores, which is another 200 basis points more than whatever you see here, which to me is the more important number.
Absolutely, sir. So, frankly, crossing a 13% EBITDA margin in a quarter that still had some impact, maybe we can't really consider being a complete normalized quarter. Does that mean the vision for EBITDA margins kind of get reset for the future?
It always does. I mean, see, we had in 2016 when the market was quite bad. I think we had boldly laid out a vision that nobody kind of thought was deliverable. But I think quarter on quarter, year on year, I feel we've done that. And that's the feedback we got from the community as well. We will come out with our new vision. It will be bold, it will be big, it will be audacious, but it will be sustainable and smart, in our opinion. I feel we've made bold calls, and even in real estate, while it seems that our number of store openings are what they are, but when we get there, it's a 25-year deal, it's a 20-year deal, it's a deal that is sustainable. And many examples of locations that otherwise would not have come through to us. If you look at the international departure McDonald's that is there, everybody's talking about it. It's a beautiful store. Volumes are phenomenal, and we actually are profitable. And that's the kind of store we like. It took us time, but we are there. So, that's sort of our philosophy, and you will see margin continuously rise from here on. And we will bring that out in our vision document, the 3 to 5 year vision document.
Sure, sir. All the best for that, and congrats for a very strong quarter. Thank you.
Thank you very much.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Kapil from Edelweiss. Please go ahead.
Thank you for taking my question, and congratulations on a great set of numbers. Sir, in terms of revenue per store, we have touched around 6 crores per store, and if we compare this to our closest burger competitor, it would be around 4 crores per store. So, apart from the cafe segment, there would be the number of mature stores also that would be contributing to a great extent. So, what would be the mature stores as on today, as a percentage of sales? As a percentage of total stores for us, and also what would be the average revenue per store for these mature stores?
You see, I don't ever believe that stores mature, because I'm not saying 3 years from now that these stores are not going to come or give same store sales growth. Also, last year we effectively did not open any stores. So all the stores that we are talking about, so our growth of the 47% is largely from existing stores, and all of them have been open, I think 24 months or 20 months ago, because the pandemic has been around for that long. So, we feel that this mix is giving you this average unit volume. We feel that's quite positive.
Okay, sure. And sir, a couple of bookkeeping questions from my side. So, like the Meg delivery hubs, have given a very good sales number this quarter. So, what would be the number of Meg delivery hubs as on today, and what sales contribution would be from here?
The total number of hubs would be, I'll tell you right now, about 240. There are 240 delivery hubs. We don't share the breakup per hub actually.
Okay, sure. And sir, one more thing. From the total number of stores, outlets, if we see, it seems that you have closed 2 McDonald's stores this quarter, because the last quarter the number was around 310 stores. Now since you have opened 8, so probably 2 stores must have been closed. So could you provide some color on it?
No, these 2 stores were relocated, so they were not added as new stores. They've been relocated, not closed.
Okay, sure. Thank you for answering all the questions. Thank you.
Sure. Thank you.
Participants, you may press star and 1 to ask a question. The next question is from the line of Hasmukh Maseria from SUD Life Insurance. Please go ahead.
Hi. Thanks for the opportunity. I just wanted one clarification on store opening. So in last quarter, you had mentioned about doubling the store count over next 3 to 5 years, let's say, which should translate roughly to 600 to 160 to 100 stores per year. And in this quarter, you are mentioning about 40-50 stores every year. So can you tell us, is this 40-50 only for FY23, and will this number increase going ahead to reach 500 stores by FY25-26? Or how should we look at it?
Sure. We don't see my philosophy around store opening. It's always over a 3 to 5 year horizon, and we do not talk about quarter and years. What we are telling you are 2 things. We are telling you that we will do 200 stores more in the next 3 to 5 years, and we are saying next year we are going to do 40. The rest is all math.
Okay, understood. So now the revised target is 200 over next 3 to 5 years, and not double, which was, let's say, 300 stores for next 3 to 5 years.
Yeah, you can say that. I mean, like I said, we will come out with a vision, but very firmly, we are talking about 200 stores over the next 3 to 5 years with 40 openings next year.
Okay, understood. Thanks for answering this. Thank you.
Thank you.
Thank you very much. Ladies and gentlemen, you may press star and 1 to ask a question. Participants, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity again, sir. Sir, with regards to this chicken burger, now has it been introduced all throughout? I mean, earlier I think it was only the southern part of India. So now is it available all across your network?
No, it's right now the fried chicken's only in South India as of now.
Okay. And sir, I think last time you mentioned around, that approximately 50 lakhs of incremental contribution is expected from the fried chicken burger. So one clarification on this. This incremental contribution would only be for the southern stores because it's introduced there. And how has been the progress so far?
Yeah, so right now it's only in South. It will of course come to West, but right now this incremental volume that we've talked about is for the store base in South.
Sure. And sir, what has been the progress so far? Are we
West India, of course, we got the gourmet burgers, so that's what sort of given a fillip here as well.
And sir, what has been the? So are we reaching near that 50 lakh contribution on an annualized basis now? in these certain stores, or how has been the progress there?
See, we normally don't share details like that, but basically that's the number that we have reached, which is what we've shared. Our ambition does not stop there. We do believe that as the consumer starts connecting bone-in chicken and fried chicken to our brand, we believe that over the next 2 to 3 years, this business is going to grow quite exponentially. You can do your own channel checks, but the customer feedback around our product has been extremely, extremely positive, and that puts us, on a good wicket, and we are quite bullish about this particular business.
Okay, sure. Thank you.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Nihal Jham from Edelweiss. Please go ahead.
Yes, thank you so much and congratulations to the management. So just one question from my side on the store opening target. When we are looking at this target of 500 stores over the next few years, do we have internal plan of how many cities do we expect this to be in? Currently, we've been in 43, and I think over the last couple of years that number has more or less stayed the same, but just wanted your perspective on that.
Sure. Our philosophy is around ensuring that we continue to gain market share in the cities we operate in, because cities are changing very dramatically and we don't like to lose our share there. Yet at the same time, in the next 3 to 5 years, we want to add at least 20-25 new cities as we kind of expand our network and we spread our roots into the interiors of the country.
Absolutely, that's helpful. The only related thought to that is that in one of the earlier questions you were asked about the store sizes. So as say you go deeper and beyond the tier 1 or tier 2 cities, ideally smaller store formats would work depending on the areas that those stores do. So you are still sure that even as you go deeper into the remaining 25 cities, you would keep the store format between the 2,700 to 3,000 square feet?
In fact, our learning is, at the end of the day, we do operate in 43 cities, and they include the smaller cities to the largest. And our experience is that in smaller cities, family sizes are much larger, and the occasion for consuming is very concentrated. So therefore, we believe that we should have larger stores. And in fact, in many of the smaller cities, originally, we started with a smaller footprint, but we kept the space available. And if you visit our Bharuch store now, we've doubled the size. But fortunately, we kept the real estate available to be able to do it when we needed to. Because it's a whole separate conversation around what are the implications of not doing that. We've seen that over our 25-year journey.
Point taken, sir. And on the gourmet burgers, is it currently only available in a certain number of stores? And if that is the case, you could just share approximately what proportion of stores are we serving that in, and what is the plan of scaling that, and also the fried chicken incrementally to say the entire network?
So we normally do everything through the entire network, and therefore gourmet burgers are across the network. In South India, what had happened is that time COVID came in. Otherwise, our plan was to rapidly expand that. But with the gourmet burgers coming in, that's also, yes, you will see it in West India. We are just working the details out. But eventually, it will be across 100% of our restaurants.
This is helpful, sir. Wish you all the best. Thank you so much.
Thank you so much.
Thank you. The next question is from the line of Chinmay Gandre from Reliance Nippon Life Insurance. Please go ahead.
Yeah, thank you for taking the question. Sir, just on the gross margin front, I missed on that part of our commentary, what is the reason for such good margins we have put out in the current quarter?
Well, that's our secret sauce. But I was just saying earlier that over the last 5-7 years, we've been able to consistently grow our gross margin systematically, while not really increasing prices too largely to the consumer. So I think we've been able to understand the playbook around that quite well. And, it worked for us. It obviously started with a strong supply chain foundation, where right from day one, we've been working directly with farmers. And, most of our relationships with our suppliers are 25 years old. We've not had to change suppliers at all, and we've worked with them. So a lot of efficiencies come there, and for 3 to 5 years. So that's one part of it. And the other part is really the secret recipe that we have by which we are able to manage this through product mix and other ideas.
Sir, and on the EBITDA front, I mean, on a broader assumption, would it be fair to assume that the delivery would be having maybe a lower EBITDA margins because of the delivery cost attached to that with respect to aggregators, or would that be a fair assumption to make?
See, we don't see our business like that. As far as I'm concerned, we have to deliver a higher EBITDA, full stop. So if something is going to take away, what do you do to manage the other part of it? And the gross margin is the same question. So my point is that, line items have to be managed. Something goes up, something goes down. Something is inevitable and it will go up, but something else you work to bring it down. So in summary, we work on 100 to 200 basis of cost elimination every year out of the system. And it's a continuous process. It never ends. And the world keeps changing around us, giving us new opportunities to cut costs. And that is how we sort of stayed where we are. So I think that's how we will continue to manage. I'm not really getting into line items, but essentially our job, in my opinion, is to finally deliver an operating EBITDA and a PAT. So that's the way I look at it.
Sure. And my last question was regarding to the fried chicken. I mean, you mentioned that more or less we have reached that maybe on an annualized basis that 50 lakh kind of a target, right? But would this be for most of the stores in South where we have that offering, or this comment is with respect to the specific stores? Sorry?
Smita, you want to take that? I didn't get the question very clearly.
My question was, we mentioned that basically with respect to the fried chicken, we have kind of reached the 50 lakhs kind of an incremental top line addition on an annualized basis. So would that be across stores in South where the product is available, or a few specific stores?
In fact, absolutely. I mean, there are many stores that do far greater. That's the sort of average across. I wouldn't take a few stores. That would be the wrong sort of number to share. But it is across the board, and it's getting stronger by the day.
Sure. Thank you.
Sure.
Thank you. The next question is from the line of Vishal from Nirmal Bang. Please go ahead.
Yeah, thank you. Hi team, congratulations on a strong quarter. My question is on the overall industry, nothing specific to the quarter. There were talks in the last 2 years on many standalone players kind of struggling to operate, and also we're seeing closures during the last 2 years. With the markets now stabilizing, if you can share some thoughts on how things will pan out in terms of market share movement for the organized players, specifically for players like you who are present across dine-in as well as convenience channel.
I'll tell Smita to take that.
Hi. Saw in COVID that there was a change in the IEO construct. From mom and pop players, people started to go into chained and organized more because of safety and assurance and hygiene. So this is something which I think is going to be here to stay. And the organized sector is going to grow and is going to become a much larger part of the informal eating out, which till now it wasn't. It was dominated by the unorganized sector. So we can see this happening in India like it's happened in of the world. And in that organized sector, I think definitely we are a very strong player, and especially our omni-channel presence will help to get better market share as we go quarter on quarter.
Yeah, right. But have we seen anything on ground in terms of in the last 2 quarters where operations are kind of normalizing? Have you seen those players coming back on ground? Any anecdotes that you can share or any examples?
difficult to give complete, but yes, there are new players which keep on mushrooming, and I think everybody has learned kind of from COVID to make a sustainable business model. So I'm sure there will be single units which will come back, and OND was pretty normal for everyone. So I think the players which have which are single players would have definitely seen a better OND quarter, and it's not going to take away from new players coming in. There will be new players which will come in.
Agreed. Okay. Thank you, and best of luck for future. Thank you.
Thank you.
Thank you.
Thank you.
Thank you. The next question is from the line of Amnish Agarwal from Prabhudas Lilladher. Please go ahead.
Yeah, hi Amit. Congrats on strong set of numbers. I have a couple of questions. My first question is that you stated that even in 3Q there were some disruptions with regards to the occupancy in the stores, and particularly in the last 15 days, once the third wave, you can say, started setting in. So can you give us some idea that how you can say last 15 days of the quarter particularly panned out, because you have big presence in say Mumbai, Pune, Bangalore, etc., where usually we have seen that any wave of COVID has been starting from these cities. So how much and in what manner the sales got impacted during this quarter, particularly in the last 15 days?
Hi. So I wouldn't say completely sales got impacted. As I mentioned earlier on the call, we are now an omni-channel. When we saw dine-in getting restrictions and there were some curfews also which came in, what we were able to step up and accelerate was which is delivery on the go. So yes, we did see a slight impact, but I don't think we saw an impact what we saw either in wave 1 or in wave 2. So I think this is now a way of doing business, the new normal. Even in the future, if there could be some restrictions, I think all brands are now poised to be able to accelerate with their own channel mix. And that's what we did in the last 10 days, and that's the reason why we continue to have a great quarter.
Okay, but were we able to normally, you can say, conduct our delivery operations even during those restrictions or curfews, etc., in general?
Yeah, I mean, it was different city-wise. So in Chennai, there was a Sunday curfew all day where obviously we were not able to up till a certain timing. Whereas in Mumbai, there was no curfew or restrictions, and therefore delivery was flying as per normal. So it was city by city, and open when there were no curfews in Maharashtra, only capacity was impacted, and therefore delivery was also functioning and dine-in was also functioning.
Okay. Thanks for this update. Now my second question is on the margins. If I can recall, earlier our you can say thought process used to be that on a pre-Ind AS basis, in a steady state, we used to guide for a margins of say roughly around 14-15% kind of a number. Now with 13.5% margin, which Amit said we have achieved in this quarter on a pre-Ind AS basis. So do you think that over the next 2 to 3 years we can now have a margin which will be significantly better than what we used to guide earlier?
I mean, see, it has to be, right? I mean, I just mentioned earlier that every year we've given 130 basis point consistently year on margin growth. And in my opinion, any company that stops growing their earnings, I feel they shouldn't exist, right? That is the expectation of all stakeholders. And therefore, that was a vision that we set for ourselves. And I feel we've delivered on that vision, because in 2013, 14, 15, margins had dropped to almost 7-8%. So over these last few years, we've at least sort of come to 13.5% of this quarter. And essentially, obviously, our next guidance will be to push it higher. We are not going to accept that we will stay at 13.5 for the rest of our life. So it is intended to go up. That there is no doubt.
Okay. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Ashit Desai from Emkay Global Financial Service. Please go ahead.
Yeah, thanks for the opportunity. Hi, Amit. Just a question on the store openings. we have seen a little bit of back and forth on the outlook for next 3-4 years store openings. Can you give the reasons for that, and what's your confidence level in achieving this 500 stores over next 3-4 years?
No, I don't think there's been any back and forth. We generally don't give out. We had in 2016 talked about the number of stores that we are going to open by FY22. And after that, the only time we really talked about it was on our 25th anniversary. The intention is obviously to double the store base over a certain period of time. But what is a firm call is that we are going to cross 500 stores, which means we are going to build another 200 stores over the next 3 to 5 years with a roughly 40 plus openings for FY23. Next is FY23. So that is really what you can take it as.
Okay. So it's 200 stores over next 3 to 4 years.
Correct.
Okay. And is there an increase in capex per store? Because our capex number has remained the same at 800 to 1,000 crores. So is this for the additional 200 stores?
So 200 multiplied by say about 3 is about 600-700 crores right there. And then we do, as I've mentioned in the call earlier, that not only are we going to convert the rest of the stores to Experience of the Future, but we need to get McCafe to the other 20%. Plus we like to reimage. Reimaging is a continuous process because as stores age, if you don't go back and reinvest in them, you cannot long-term deliver, good results, and also the brand takes a beating. So, we stick by the numbers that we've just talked about.
Got it. And when you say 40 stores a year, that is the minimum that you would look at?
No, I'm not saying 40 stores a year. I'll repeat it again so that everybody gets it. I said that 200 stores over the next 3 to 5 years and a definitive plan of 40 stores plus next year. That's all. I'm not talking of the year after because I don't give such numbers out. I've given you a 3 to 5 year horizon and I've talked about the immediate year that's coming up.
Okay, got it. And secondly, can you share what has been the recovery in the cafe segment?
I mean, see, cafe, while McCafe is big for us, obviously with in-store not fully there, it's a more in-store brand. So it's obviously at that 80-90%, it's not yet at 100%. And, it's going to pick up. But, for us, we are a multi-purpose, all-day dining restaurant. And everything, fortunately for us, is a smaller component of a larger pie. And that is McDonald's globally. And that is why we like to operate, say, in breakfast, with beverages, which is McCafe, in chicken, in burgers, so that, we are an all-day restaurant appealing to everybody. But overall, specifically, it's 80-90%.
Okay. And actually request you if you can put the pre-Ind AS numbers on the exchange as well.
Yes, we will put that up. We will update the earnings thing and add it as an extra.
That's great. Yeah. Thanks and all the best.
Thank you.
Thank you very much. I now hand the conference over to Mr. for closing comments.
No, thank you very much, everybody, for participating and taking the time to be with us today. We appreciate it. Have a lovely evening and talk to you soon.
Thank you very much. On behalf of Westlife Development Limited, that concludes this conference. Thank you for joining us. You may now disconnect. Thank you.